The market just got shaken. Here's what happened. The past 24 hours delivered one of the most turbulent sessions in recent crypto memory. It wasn't just another dip. It was a macro-driven flush that rattled traders and set the tone for what's next. Let's break down the most important crypto market trends from the last day. $7 billion liquidated as U.S China tensions explode. It started with headlines from Washington. Donald Trump's announcement of 100% tariffs on selected Chinese imports triggered waves across global markets. What followed was a ripple effect that smashed into the crypto sector. More than $7 billion in crypto positions were liquidated in less than a day. Derivatives traders bore the brunt of the move, with both longs and shorts getting wiped out during the extreme volatility. This was a reminder of how deeply macro news can influence crypto, and how sensitive the market still is to political instability. The addition of export control threats only added fuel to the fire. One important thing to note: while the selling was sharp, such massive liquidations often clear out excessive leverage, setting the stage for a more stable market, or even a rebound. But the pain was real. Bitcoin drops 5.5% amid global market shock. Bitcoin, BTC, wasn't spared. In the immediate aftermath of the tariff headlines, it fell by around 5.5%, bottoming near $114,505. Traders scrambled to reassess risk as uncertainty took hold. While Bitcoin has seen worse, this sharp intraday drop shows that volatility still rules crypto markets, especially when geopolitical pressure builds. Technical analysts point out that Bitcoin remains in its wider consolidation range. But if macro shocks continue, further downside risk can't be ruled out. At the same time, seasoned investors view these shakeouts as opportunities, especially with institutional signals flashing green. Institutions are betting big despite the chaos. If the liquidation headlines scared some off, big money is moving in deeper. Two major announcements point toward a rapidly maturing crypto infrastructure. ICE commits $2 billion to Polymarket prediction platforms. In a move that few expected, Intercontinental Exchange, ICE, the company that owns the New York Stock Exchange, pledged a $2 billion investment into Polymarket, the popular decentralized prediction platform. This isn't just a bet on crypto, it's a bet on the tokenization of event-based markets. ICE sees long-term value in turning real-world events, elections, economic data, geopolitical risks, into blockchain-traded assets. This could open a new class of crypto-native trading tools that extend beyond traditional assets. It's also a sign that Web3 infrastructure is being taken seriously by legacy financial giants, who are building quietly but significantly. S&P launches a hybrid crypto plus stocks index. Another headline: S&P Global just launched the Digital Markets 50 Index, a new financial product that blends 15 major cryptocurrencies and 35 blockchain-related public stocks. This index aims to give investors a broader snapshot of the digital asset ecosystem, capturing not just tokens like BTC or ETH, but also companies driving blockchain development. Here's the kicker: the index will be tokenized via Denari, a tokenization infrastructure platform. This marks yet another bridge between TradFi and DeFi. By tokenizing the index, S&P is opening the door for on-chain exposure to regulated financial instruments, and possibly making it easier for institutions and retail users to access diversified crypto investments. Political power plays are just getting started. While the market was reacting to short-term headlines, the crypto industry continued to look ahead. Crypto's political muscle: over $130 million spent in U.S. campaigns. In the backdrop of it all, crypto's growing influence on politics is becoming clearer. According to recent reports, the crypto sector has already spent over $130 million in recent U.S. election campaigns, and it's just warming up for the 2026 cycle. The reason? Regulatory clarity. As policymakers gear up to pass new digital asset laws, the industry is pushing hard to shape the outcome. Lobbying efforts are increasing, and pro-crypto candidates are gaining traction. This suggests that regulatory headwinds could shift to tailwinds, a critical development for long-term crypto growth in the U.S. If new laws provide more certainty for stablecoins, DeFi, and token issuance, the stage could be set for an institutional acceleration that dwarfs anything seen before. What it all means for crypto investors. These fast-moving developments underscore a few key lessons about today's crypto market trends. Macro risk matters more than ever. From tariffs to tensions, big-picture politics move the needle in crypto. Institutional builders are not slowing down. ICE and S&P show that the foundational layer of Web3 is still being laid, with billions behind it. Regulation is in play. The 2026 U.S. elections could reshape the crypto landscape. Stay informed, especially on legislative proposals. Volatility equals opportunity. After big liquidations, strong rebounds often follow, but only for those who manage risk wisely. Subscribe for more fresh crypto updates.